Think about the last time you made a quick decision about your money. Maybe it was buying a stock because it was trending or skipping out on that high yield savings account because you assumed it was just too good to be true. There is this great quote from Jay Shetty's Daily J that I listen to every single day on the Calm app, not sponsored, but I love that app because it gets my mind in the right space for the rest of the day. And in this quote, particularly, he says, when there's a gap in our information, we often build a bridge based on assumptions, only to arrive at false conclusions. So true. In everyday life, a false conclusion might just mean some awkward misunderstanding. But when it comes to finance, a false conclusion can cost you thousands of dollars, or even worse, derail your entire financial freedom journey. We don't want that. So today we're going to talk about that assumption trap. We're going to identify some of those traps that you might not even know that you're doing. And then we're going to help you stop guessing your wealth away. So if that sounds good to you, that is our topic for today. It's a heavy one, but it's an important one. Before we jump in, though, I just want to quickly introduce myself for anybody who's new here. I'm Lisa. I'm a financial advisor. I have been for over 15 years, and I help people get to financial freedom as quickly as possible. And as I work with people, we go through common mistakes like these assumption traps and try to avoid them so that people can get to their goals much faster. Okay. So I've said this a million times. The financial markets are flooded with noise, right? You've got the news headlines, you've got the influencer gurus, you've even got maybe well-meaning financial or family members, constantly giving you snippets of data. But it's always incomplete data and it's always opinion-based. When we see a headline that says housing market is crashing or this AI stock is the next Nvidia, those are opinions, but those headlines create a gap. Our brains hate gaps. They want to complete the story. So what do? We fill those blanks in ourselves. Our brain does it. We assume a crash means we should sell everything, or we assume a hot stock means it's guaranteed riches. So let's look at how we build these dangerous bridges based on assumptions. Let's go through 3 common assumption traps. One is the panic selling assumption. So the market drops 5% in a week, maybe, and the assumption is it's going to zero. I'm going to lose everything. I need to get out right now. The reality is short-term volatility in the markets is very normal. By acting on an assumption, you could lock your losses in and miss a recovery. It also could continue to go down. So assuming is taking a chance, but you want to make sure you're taking an educated stance at it and making decisions based off that fit with your risk in the first place. Another assumption is the too late to start assumption. Maybe you're 40, late 40s, and haven't saved very much. The assumption is it's too late for compound interest to help me, so why even bother? And the reality is every dollar saved today is better than zero. You still have plenty of time to let your savings and growth help you in the long run. And the last one we're going to go through, there's definitely more than this, but the last one we're going to go through is the FOMO assumption. This one is happening a lot, especially with all the IPOs and all that stuff happening in the markets. I am talking to people a lot about this one. Let's say there's a stock and it's skyrocketing. Your assumption is it's going up forever and I'm missing out because I didn't get in at the basic low. I've got to get in now. And the reality is you could actually be buying at the absolute peak based off of hype, not financials. You have to educate yourself to make better choices for you. Also consider your risk. Does that stock fit your risk tolerance? So how do we fix this? A continuation of the quote from Jay Shetty that I started will give us the exact blueprint. Rather than guessing, wait until you have all the pieces of the puzzle. That again is so true. In finance, waiting for the pieces means practice due diligence. Before you move your hard-earned money based on a gut feeling or a headline, ask yourself these 3 questions. Number 1, do I actually understand how this financial product works, or am I just guessing? That goes with stocks too. You might know how a stock works, but do you know about that individual company? Anything at all? Most people don't. 2, the second question you should ask is, am I looking at historic data and facts, or am I just going off of short-term hype? The third one is, does this decision align with my long-term strategy, or is this an emotional reaction? I will tell you 99% of the time, it is that emotional reaction that is spawning this. So next time you feel rushed to make a financial move because of this gap in what you know, just take a breath. Ask yourself these 3 questions. Step back. Don't build a bridge out of assumptions. Wait for the facts, look at the numbers, and piece the puzzle together safely. Your future self and your bank account will thank you. So, what's one financial assumption you used to make that now you've corrected? Go in that with a positive way of looking at how you've done this in the past, and you can continue to do this in the future. That is my motto. So, until next time, be safe, be strong, be kind to one another, and see you in the next video. Bye-bye now.